eOne's strategy is very straightforward. We are looking to double the size of the business by FY20. That doubling of the size of the business will come through increased investment in content and also improvements to the capability of our global sales infrastructure. We're looking to increase the investment in our content across our three divisions: family, television and film. And based on the success that we've seen to date in the first half, we're very much on track to deliver that target. Over the last few years, we've seen a very significant shift in the industry and in the way that the industry serves its consumers. We've seen the rise of people like Netflix and Amazon, SVOD digital platforms. And that has led to a significant increase in the amount of demand for content. eOne is positioned brilliantly to take advantage of that trend, as we are a producer of content, an acquirer of content, and we sell to those digital platforms. We sell to everybody around the world. So we're in a very good position to take advantage of that global trend for more content. This has been a great first half for the group, with growth across all of our divisions. We've seen film rebound with strong growth in the box office. We've seen our television and our family businesses grow in line with our increased investment that we've been putting into those divisions. We're very much in line with our management expectations for the full year. Television is progressing really well, and the first half is no exception to the progress that we've made over the last few years. We've seen significant increases in investment, and that is really reaping rewards for the television division. Our second half looks great, and the bulk of our revenues are already commissioned or contracted for the full year. Good examples of that have been the Mark Gordon Company, which has delivered a fantastic set of results this half, driven primarily by its production Designated Survivor, which has been a global success. It's been picked up by ABC in the US and Netflix outside of North America. Family is developing really well and seeing significant growth across all of its brands. In particular, Peppa Pig has seen good growth in the period and continues to see good growth in the second half. That growth is coming in the US and also in China, where those are the significant markets of development for the business over the next few years. Elsewhere in the family division, we're seeing good development from PJ Masks, which is being viewed to great success around the world on the Disney platform. And we're starting to develop our licensing and merchandising programs, particularly in the US, where it's been a big hit. Elsewhere in the family division, we're also seeing the development of new brands and the success from existing brands such as Ben and Holly's Little Kingdom and Winston Steinberger and Sir Diddley Ding Dong. First half performance in film has been really encouraging, and we've seen that come through the strong performance of the box office, which has been driven by high profile releases such as the BFG in the first half. That strong performance in box office continues in the second half. We've also seen great release results for The Girl on the Train, Arrival and I, Daniel Blake, to name just a few. Altogether, that puts us in a good position where we remain on track to deliver the performance we expect from the film division in the full year. Investors can expect to see more of the same in the second half. More deliveries from our television business, more growth from our family business led by Peppa Pig and PJ Masks, and more success in our film business driven by the improvements in box office that we're getting, which will then impact on the ancillary windows in the second half. Overall, the group remains in line with our expectations in terms of performance for the full year.